We're back with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. We spoke last with Chris on Monday, August 5th, the huge day when we had that huge drop in markets. Volatility spiked, the VIX spiked to 60. Well, things have calmed down a bit since, bit of a rebound in all risk assets. So we'll talk about what's next with Chris. Welcome back, Chris.
Hey, thanks, David. Always a pleasure.
Big day we had you on 2 weeks ago, exactly 2 weeks ago. So right now, my first question is whether or not this rebound is the start of a new sustained bull market, or is this a dead cat bounce? What, dead cat bounce for 2 weeks, I guess, but I'll let you answer that.
Yeah, that's a good question. Last time you and I talked, we had a major market correction at play. We talked about how the market, especially the Nasdaq. If I share my screen here, if we take a look at the Nasdaq, the QQQ, we had that huge move that you and I talked about in the morning, where the market had a Fibonacci measured move. This is just using the recent sell-off and the bounce. The Nasdaq, let me zoom in a bit here, had this huge gap to the downside. So a massive gap to the downside, opened at 100% measured move, which is, long story short, the market has momentum. When it has a bounce, you can use the momentum for the first half to gauge how much the momentum in the second half will have, the halfway point. And that was right here, this 100% measured move. And as you and I were talking that day, this is a point where most people ejected out of the market. The VIX was up 176% in pre-market. We haven't seen levels like that since COVID, since 2008 financial crisis. Everyone was getting out of the trades. And I was talking to you saying, like, this is actually the point where we should have nothing but like a rip your face off rally or bounce, a dead cat bounce of some sort. And everybody literally sells out at the bottom where they think the world's falling apart. And that is exactly what's happened. This market has ripped to the upside. And now we're at that turning point, as you just asked, like, is this a bounce or is this the start of a new rally? And of course, we don't know yet. Nobody knows yet, but we have seen some signs of a few different signals here in the market. Long story short, if we look at this 30-minute chart here on the left of the NASDAQ, we saw yesterday the market ran higher and it pushed up right into the closing bell. And we actually had this red indicator above, way up here at a reading of 5. And what this is, long story short, is the money flows, the volume flows on the New York Stock Exchange. When it's above 3, that's telling us everybody is buying on the ask, meaning they're literally just saying buy. They don't care what price they get. When everybody is piling in, and then we see this squeeze into the closing bell, which is a quick rally, it really shook the shorts out of the market. Everybody piled in. And the stock market right now is at this major resistance area, huge consolidation right here, another consolidation right here. We had a bit of a short squeeze, so the shorts just got squeezed out yesterday, and now the market pushed up a little bit this morning as you and I are talking, and it's starting to sell off, and we might be going into a bit more of a pullback. And this is where we'll really figure out, is this just a pause and a pullback before it goes higher and maybe hits new highs? Or is it going to be, another huge correction and lots of volatility? And so we do have to wait to figure that out. But the underlying technicals on the daily chart continue to strengthen. We're getting very close to potentially the stock market saying, hey, there's actually good money flowing into this, and it might be worth getting back in. And I say that because we have very similar setups here. If we take a look at the SP 500 and we just zoom back a little bit, we have the same setup that we had during this crash right here. That cycle low was the same type of multi-cluster cycle low as we had over here and also over here, along with panic selling and money flows. And as you can see, these rallies are getting shorter, but they are very significant standout lows. And so we really just need to see where this market is going to go over the next couple of days. We're so close to potentially getting long equities again for another push higher. Again, we never thought the market was really going to, we played this move up. We thought the market was going to roll over. We got into this one. We thought the market was going to roll over. And this one feels like the market's going to roll over again, but you have to have a strategy. You have to follow rules, because if you don't, you're going to get left behind in this market, and missing these rallies is super costly. And so that's what we're waiting for, is confirmation of a new uptrend. This, at this point, is still a dead cat bounce, and it could reverse and sell off just as quick as it came up. In fact, it could roll over even quicker. So we have to get a little bit more confirmation, but we're definitely at a critical turning point where there's new opportunities to be had here.
Before we continue with the video, let me tell you about how to protect your online privacy. Do you know how much of your personal information is on the internet? Well, data brokers collect and sell your personal data, exposing you to risks like identity theft and potentially harassment. But there is a solution. Delete Me, the sponsor of this video. Delete Me removes your personal information from hundreds of data broker websites. I use Delete Me myself, and it's simple. Just submit your information, and their privacy experts handle the rest. In 7 days, you'll receive a privacy report showing where your data was found and removed. Delete Me continuously monitors and removes your information all year long. Now, get 20% off on consumer plans with Delete Me. Go to joindeleteme.com/David Lynn and use the promo code David Lynn at checkout. You can also scan the QR code on the screen here directly from your phone. Join the thousands who trust Delete Me to keep your data private. Get Delete Me today and start taking control of your online privacy. Of course, we have the benefit of hindsight. We can look back and say 2 weeks ago, yeah, it made sense to have bought on the fear. But when it happens to you live, Chris, on a day when you have a massive correction and a massive panic selling across the board, the VIX is spiking, what do how do you make the conclusion that this is going to result in some sort of bounce as opposed to the beginning of a larger downtrend?
Right. Well, you can't really. I mean, there usually when fear hits a certain level, a lot of things lined up specifically for that day that you and I talked about. I mean, we didn't buy into that. We
Yeah.
saw it. We explained what was going on. I talked about it in our last talk 2 weeks ago, which people could listen to because they'll see exactly live how I was perceiving it and what to do. But more or less, we don't buy dips. We don't buy something that's in a downtrend. We just identify when something's oversold, and we prepare ourselves. Hey, this could be a very strong bounce. All the criteria was there for a big move up. But it's not about buying these dips. I mean, a lot of people say, well, you missed out on a huge move. Yeah, we did. But if it kept falling, like you said, and it goes into a waterfall, like falling knife scenario, then you literally probably would have bought it at the halfway point and it loses twice as much, even further. So the key is not to try and buy bottoms, pick bottoms like that and buy the dips. That's not the way that I do it. I wait for a market to reset. I mean, we can take a look at our strategy in the top here. You can see we moved out of the market, then it had a huge correction and sell off, and then it's had a rebound. We want to sidestep some of these moves in the markets. And that's what we kind of focus on is we never know when this market is going to break down. And at some point it will have a huge breakdown and you don't want to be holding it. So the key here is just to understand what is going on with the traders, figure out the money flow, figure out where the cycles are and support levels. And then you can just gauge, okay, we should probably see a very strong bounce here because it's a massive gap down in support, measured move, panic, in the streets, headline news. I mean, everything was there for, a perfect rebound to catch most people off guard.
If we take a look at, do you mind overlaying exactly what you have with the Russell 2000? What I'm getting at is we're starting to see a little bit of divergence. The Russell's been selling off the last 1 day, 1 or 2 days. The S&P, not so much. The large caps have been holding steady for the most part, while the small caps have been moving down. And I think this is the first time we're seeing divergence since August. Well, since before the big correction on August 5th. So I wonder if we're going back to our old days of divergence, Chris.
Yeah, I mean, it's definitely if we take a look at like I like the RSP plus IWM, which is the Russell 2000, and IWC. If we take a look at these three symbols blended together. So this is the equal weighted SP 500, Russell 2000, and microcap stocks. So the majority, the mass majority of stocks, if we just kind of zoom out, there is no doubt in my mind here that we are in this giant complacency move. We've had this big pop in small caps. Everybody piled in about a month ago. Just like we saw before the market topped over here, you and I touched on this in our last talk. It's actually what we saw back in 2008. We saw a pop in small cap stocks just before the bear market. And so, we're setting up for another one of these kind of potential bear market phases. I think we're going to continue to see small caps and stocks on average struggle and move lower. It really is going to come down to what do the Magnificent Seven do? Like, are people going to, have the balls to step back in and start to buy them again? I mean, they just had the crap scared out of them like 2 weeks ago on that collapse. So the question is, are people going to move back into the Magnificent Seven? It's funny because when they were moving out of the Magnificent Seven, that is when we saw the Russell 2000 pop and have the huge flow. So everybody moved out of the mega caps and piled into the small caps. And that's exactly what happened just before the last bear market. So I do think we're going to see the stock market start to sell off. We're probably going to start to see, I think, technology I think people are going to be nervous to get back into the big techs. I think it's going to be a slow bleed and we're going to start to see the markets move lower. I think as a whole, I think we're going to see large caps and small caps actually start to move lower at this point. I think a sentiment has changed a little bit with that big wave of fear. People are buying this bounce still, but I do think, in the next couple of days, the next week or so, we're going to know if it's the start of a new leg higher or if it is actually just a top. The market bounced from an extreme oversold to now it's an extreme overbought and ready to pull back.
Well, Chris, asset revesting. All right, we'll talk about that in a bit more detail towards the end. It's one of your strategies, but part of your strategy is to preserve wealth, and I think wealth preservation entails holding risk assets, a combination of risk assets, safe haven assets, and cash. Let's start with cash. How much cash is somebody be holding right now in light of recent volatility, in light of the uncertainty of where this market is headed?
Yeah, so it's going to depend on your time frame. So long story short, if you are a long-term investor, we're still in a bullish environment. So we had a buy signal way back over here in 2013. The tide is still going up. Now, mind you, technically you should be long stocks if you're a long passive investor. But if you and we're getting to a point here where this scenario that we have is actually very similar to this scenario. So we do have the longer term charts. The underlying technicals they've broken down. It's just the price has not followed suit yet. So we have to see what's going on. So a long-term investor who's not micromanaging anything should still be long the equities market in general. Now, if you are like a shorter term investor, actually, I can just go back and take a look here. If we take a look at our shorter term strategy, which is our more active asset revesting strategy, more or less, we're out of the market right now. This type of volatility and setup is very similar to the same setup we had over here. And so we are 100% in cash. Obviously, these two strategies can clash a little bit because they're totally different time frames. But the key here is to be able to take advantage of the upswings, avoid the sideways moves. So it really comes down to if you're an active trader, technically right now you should be in cash. We're waiting to see if this is a bounce or the start of a rally. If it's a new rally, we're going to hop on and ride it up. If it rolls over, we'll be looking to get into some different asset classes. In fact, bonds are one of those asset classes that has finally just come into favor, literally like 2 trading days ago. Hasn't been in favor for years. So it really comes down to your trading style. And right now, if you're more of an aggressive, active manager, cash is key. But it looks like we're going to have some new trade setups here in the next few days.
If I were to find one or two assets that could weather a storm, any storm, what would that be? In other words, an asset that may hedge against volatility. And we know gold, we'll talk about gold in just a bit, but gold doesn't really do that during a fire sale day because everything goes down, correlates to one. Is there
Yeah.
anything else that goes maybe the opposite direction or to stocks or just hold steady besides cash?
Yeah, it's going to depend a little bit on your style of trading. Like one of the simplest, this is the most simple, most boring position you could be in here, which is bill, which literally it's just an equivalent to cash. You buy this
Interesting.
ETF, you get paid a daily interest, and then at the end of the month, if you didn't sell it at a higher price, all that interest is paid out in a dividend payment. So the stock market could be in free fall mode and dropping 30, 40, 50%, and you just move to this and your account goes up every month, every quarter. At this point, you're making like 5% return a year while the stock market goes down, potentially 40 or 50%. So this is a boring position, but it is a position. A lot of people don't realize the power of cash. Warren Buffett, obviously massive in cash holdings. All kinds of people talk about cash. is one of the safest plays and one of the best positions when everything is falling apart. I don't care what inflation is. I don't care what else is going on. I would much rather keep my cash and let inflation do a little bit of damage and earn interest than hold something that's going to drop 30, 40, 50%. So it's about preserving capital, reducing risk. So this is one of those plays. I think another play could be the US dollar. I think the US dollar index, now a ton of people are super bearish on it, although they've been bearish on it forever, just like people have been super bullish on silver forever. I still think we're going to see the dollar continue to move up. When we look at it from a long-term standpoint, I think we're going to see this dollar eventually, when the stock market does start a bear market, the dollar is going to work itself up. And I think we're going to see very strong gains. I think we're in a similar scenario that we saw back in 2000 in terms of commodities being the most undervalued, stocks and real estate being the most overvalued. And when people get nervous, they move to the dollar. It's just that kind of safe haven play. We see the dollar move significantly during bear markets and corrections, moved 25% or so in 2008. It had a big pop and blip during COVID, which was more of a news driven kind of crazy event. But I do think the dollar is actually still going to be a relatively stable play. We'll have to see, obviously, a lot going on in Japan, the yen, to see how the dollar index plays out. But that will be the other one that I like to look at. The dollar's got great upside potential, and it's very low volatility. In 2022, we saw the dollar. I mean, it had a massive rally. It rallied like huge. Just in 2022 alone, it rallied something like 15 or 18%. And that's what we moved into during 2022 for some of it, while the stock market was falling. And the biggest pullback along the way was less than 4%. So lots of upside, very little downside. It's slow moving. You're not going to wake up down 10% or 5% or 3%. It's a very comfortable alternate asset to move into. And this is all stuff that we rotate through with the asset revesting strategy that I talk about. It's all about managing risk and positions, preserving capital, and whenever there's an opportunity, we move into it to grow.
Do you look at RSI, for example, as a momentum indicator? Momentum indicators overall, generally speaking, do you use them?
I don't. And I think I look at momentum indicators actually very different than others. So most people, when they see the RSI in the upper band, like above 70 or 80, and it's in the upper range, people are always like, oh, it's overbought. It's overbought. But to me, that's like the market flexing its muscle. When it gets above 70 or 80, that's actually when you get the strongest
You know,
moves.
it's interesting because I interviewed Jack Schwager, who was the famous author of the Market Wizards books.
Yeah, great
He's
book.
interviewed he's interviewed some of the best traders in the world. He told me the exact same thing when I had him on the
Mm.
show last week, that the
And
traditional way of using RSI is to short at 70, long at 30 or below, but historically, if you actually just take a look at the data, he said he said the exact same thing. You're supposed to follow the momentum over the longer term. You're going to have a better result if you actually stay long above 70 and short below
yeah.
30.
And
So
exactly, David. And that's what I focus on with my band strategy, the best asset now, where we trade like the hottest sectors. It's all based on momentum. Once something has got momentum, it's more likely to keep on going. Actually, it pick up more momentum. Whereas a lot of people do the opposite. RSI gets overbought, or so they think it's overbought. Meanwhile, it's actually like the power zone. And literally they're selling their positions and getting out, locking in small gains just before it takes off and everybody misses the big runs. It's
yeah.
the market's phenomenal at taking people's money or making them miss out.
Let's talk about gold. Power run or overbought? Let's take a look at what you think. It broke 2,500 last week, a new all-time high. I've heard that the momentum is going to continue, but I'll let you take a look and answer that for us. Is this momentum going to continue, you think?
I do. I think it's on the verge. It's squeezing up. Like we got hit on that big sell-off day with equities. It pulls gold down, which is exactly what you kind of were kind of hinting to earlier. Like gold, if we go into a bear market and a recession, gold generally gets hit pretty hard. It's not actually a low volatility play during a bear market. It can fall 30, 40%. But we're seeing this squeeze up. I still think we're going to see gold continue to move up to roughly 2650, and then potentially 2750. So there's still more upside. Obviously, it's getting closer. When it hits that level, I do feel like the main move for gold is over. I think we have another couple of months potentially of higher pricing. I think we're going to see gold, silver, and miners start to pick up speed, and it could actually happen fairly quick. It might not actually be a multi-month move. This might happen in only a couple of weeks. It is primed and ready, and it's about to pop. So I like gold from that scenario, and we are in the sweet spot when we look at cycles in the markets. Let me just pull that back up here. If we look at cycles, we tend to have gold do very well right near a major market top. And all of these three different groups of stocks and commodities are doing very well. Energy stocks are at near all-time highs. And so all these things are telling us, hey, this is the big scenario. And the weekly or the monthly chart of gold really makes this crystal clear that we had this new super cycle starting in gold. We've had a multi-year consolidation. Well, we had a new super cycle in gold in early 2000. We had a multi-year consolidation. And then here, just before the last financial crisis, we saw everybody move to gold as the defensive play. And that's where we are right now. Everybody's moving into gold for that defensive play. And then I think we're going to eventually see gold pull back, just like it did in 2008, which was 34%. As you mentioned, there's volatility to gold during a bear market. It's pretty wild still.
How did
And
you
then we're
come
going to
up
go
with
into a
your?
multi-year rally. So everything is unfolding. You and I have been talking about this for months. We keep updating kind of month after month,
Yeah.
and the chart pattern is just unfolding as expected. There are no surprises here, and I've always been mentioning gold is the best one. Forget silver, forget miners. If you just want a low volatility, high probability trade, something that'll make you money and not make you sweat bullets, just GLD or physical gold is the way to do it. And that's perfect. That's exactly what's happened. Silver is struggling. Miners are still actually struggling. Gold is just letting loose and moving up.
Oh, hold on. I'm going to come back to what you just said here, but before that, $2,700 target. How did you come up with that upside?
Yeah, so we can use Fibonacci extension. We can use based on this. So there's a few big patterns here. Let's just pull up, clean the chart. So we have a few different patterns. We can take the low using Fibonacci extension up to this high, and then down to this low, and this gives us roughly. I didn't draw it perfectly, but this gives us the upside targets of where price should move, and 26. 2650 area. This next level is the next upside move for gold. So there's not a whole lot more upside based on that. We can also go back from the last super cycle and say, okay, well, based on the last super cycle, which is this is the first leg up, then this is a big bull flag or a big consolidation pattern. And then we have the second half of the leg, which is happening right now. We can gauge where that next move will be. So we can go from the low to this high, and we're going to tie into this low down here. And if you take a look where that goes, that also is around that 2700, depending on where we connect these lows. We're right up into this area. So there's not a whole lot of upside. The daily chart and the monthly chart going back like 20 years are both pointing to the same price level. And what is really crazy is that long-term chart has this orange line right here. This is the 618. And I always tell subscribers, I say, if price hits the 618 and pauses and has a pullback for a while, then we're going to go up almost always and hit that 100% measured move. And that's why there's so much conviction, why I've been talking about this. This is like the no-brainer. I hold a lot of physical metals, and we're just letting this go up. This is just a big, slow, easy kind of trend. So once we hit this level, though, this 2700 is right at smack dab in the middle of the patterns. It's like all game, like all things are off. Like who knows, gold could go into a free fall, pull back 20 or 30% potentially. And then, the market will be falling apart at that point. So that's kind of the scenario that I see unfolding.
Okay, the miners, you say they were struggling. What do you mean by that? Because I'm looking at the GDX, and year to date, it's just starting to outperform gold. I know in a bull market, maybe it should be outperforming more, but according to the analysts I've talked to, it's probably just because this bull rally is going to come a bit later. But I'll let you address this.
Yeah. So, I mean, when I talk about it's not really outperforming. I mean, it hasn't broken highs from,
I see.
2022.
Yeah.
It's nowhere near the highs gold is at all-time highs and miners
Yeah.
are still struggling, right? Percentage wise, yeah, miners have made a very strong percentage move in the last little bit, but they're
Hmm.
definitely not outperforming. We generally want to see miners dramatically outperforming, generally on both the long and short-term charts. That's
I,
where the
I
real.
I know from a technical perspective, you're looking at this and it's easy to make a case. I'm not saying that's what you're making. I'm just saying some people are making the case, well, it's got 50% upside because it should be at all-time highs. Like, look at what gold's done. But then you look at the fundamentals and you're thinking, well, there's probably a reason it's still like 50% lower than its 2011 highs. Maybe I shouldn't get into this space. So there's just different ways to look at the same data. How do you interpret it?
Yeah, I mean, I follow price, but for sure, I think there's a lot behind the scenes. I mean, gold is almost always getting harder to get out of the ground because they're slowly eating through the reserves. We have obviously inflation that is through the roof in terms of fuel. Machines cost more, maintenance costs more, labor is crazy high. So these miners, I mean, it costs a lot more to get gold out of the ground than ever. They don't make nearly as much as they would have been back in 2010. A huge difference in what's going on. So I think that's a big part of it, in why
Hmm.
they're maybe kind of lagging and underperforming. I think
Yeah.
gold probably really needs to pop and break out and get above 2,700 and go beyond before I think the miners really start to take off, where the costs become there starts to become some real profits for these companies. But yeah, I think there is a lot behind the scenes that it's very labor intensive, machine intensive, costly. And of course, the COVID bubble has caused a chaos for miners to actually be able to make money.
Right. I like to close off on bonds now. A very important pivot may be coming. I think you told me offline. The TLT in particular we'll look at. So the 10-year yield has been falling from 4.5% earlier in the year to now 3.8 was the last reading I saw. So big dramatic fall in the yield, which means positive for bonds if you're continuing or if you expect this trend to continue. What's your outlook here?
Yeah, so it's definitely a really interesting scenario. So the price action, again, this is the monthly chart of bonds. Now the price action, that we've seen, this waterfall sell off and these types of rounded bounces and the increase in volume, is a signature pattern that the market is putting in a significant bottom. Uh, in just a couple of days ago, bonds have finally turned a corner where they have been out of favor pretty much since the day they peaked and we got out of them during COVID.
Mhm.
It gapped up like 15, like a huge move, 19% move in a couple of days. It was pretty wild. They have not been in favor. We have not held on to them. We don't want to own them, and they have dropped dramatically. But just now they're starting to come into favor, meaning that if the stock market starts to go down, we could actually maybe move to bonds and actually, continue to grow our money. And this is one of our key assets that we move to when it's favorable with our asset revesting strategy. And if you take a look at, so this might be a little complicated for people to see. I'll try to make it really simple. The top chart is our asset revesting strategy. It's the SPY daily chart. And more or less, when we're long equities, you don't want to be long bonds. Whoops, they go in the opposite direction. They go down. And then suddenly, once things turn, when the stock market says, "Hey, get out," because it looks like things could roll over. Let me just realign these charts up here. Then you can see here we could have moved into bonds and actually rode bonds up and made money while the stock market was saying, "Hey, stand aside for now. It looks like the markets could go lower." And then, of course, you get back into the stock market. We rode it up. And then, of course, we had another exit. And you can see here, bonds had a beautiful run, ran like 8, 7, 8%, and continues to move up. So bonds are now just becoming favorable again as a play to move to if stocks fall out of favor. And if we go back in time on the chart here, if we just go and take a look at bonds and move back, you can see when they're green, you can see that when we're supposed to move into bonds, they actually sell off or they have a huge roller coaster ride or very little gains. They just don't pan out. And that's what bonds have been like forever. I mean, financial advisors should have moved people out of bonds years ago, and they should just be starting to look to get back into them now because none of the bond trades, this is how they performed if you were using them like everybody has for the last 40 years. And so we've sidestepped all that. But now we're coming into the phase here where they actually move up as a defensive play, a safe haven play, where I think rates have more or less maxed out and potentially could start going down, which is part of the whole reason why bonds are bottoming and turning. And so this is a huge, huge play to be able to move from equities and then move into bonds. When stocks pull back and you can squeeze out another 3, 4, 5% out of bonds in a few weeks or a month or so, and then back into equities when they're favorable, this literally can double and triple our returns. And finally, we're back into that stage where bonds are that type of play. So the next time we have a stock market signal, we get in, and then when that trend comes to an end, potentially in a few weeks, or if we get one here soon, we could be moving into bonds. And as stocks collapse, bonds could actually rocket higher, and the Fed start to cut rates. The charts generally indicate and tell us things before the news actually comes. So everything in bonds is telling us that rates have to me have topped out. It's just a matter of time before the rates start to go down. And the charts tell us all that. There's no point in listening to the news and the Fed because everybody's just guessing. And half of the people guessing will be right, and they'll say, "Hey, I nailed it," but it's still just a guess, right? Follow the trend, follow the money. The money knows more so than the talking heads on TV.
Well, I'll just close on this. It appears that the inverse relationship between the yield and the stock markets is holding. It was inversely correlated a couple of years ago, which is why the TLT has basically collapsed 2021, 2022 when the stock market was going up because the Fed was raising rates. But now I think the expectation is the Fed's going to start pivoting this year into next. And so rates are falling, stocks are going up, and yeah, it looks like the bond market is going back on an upswing. All right, so you can follow Chris. We'll end it here, Chris. You can follow Chris in the link down below. Tell us what we can learn from your asset revesting strategy here.
Yeah. So long story short, I focus on this asset hierarchy. So asset revesting is about reinvesting our capital into only the asset that's going up. We're only holding something going up in value, or we're on the sidelines. The stock indexes are the key, the most volatility. We want to hold those when they're going up. If they're not favorable, we want to move to bonds. Bonds haven't been favorable for a while, but finally they're coming back to life. This is where the heart of the money, where we can pull money out of the market. So everything is about to be firing on all cylinders again. And of course, is the US dollar index, the inverse dollar, and then bill, which is a cash equivalent. Asset revesting is all about just moving into whichever one of these assets is holding value or going up. And that's kind of the core focus. During COVID, we had the COVID crash, which was the SPY in the top chart. We moved into bonds. We caught a 19% move by just rotating out of stocks because our strategy said, hey, systems, money flow, everything is flipping. Get out of equities. We moved into bonds. There was like 19% in 9 days. And then after that peaked out, we hit our targets. We moved into BIL. We sat in cash while everybody was panicking about COVID. I mean, it couldn't have been a better play to be sitting on the sidelines and just focusing about health and family. And then, a month or so later, the stock market turned back up. We got back in, rode it higher. When you have a strategy to follow that tracks money flows, we just literally rotate from one asset, one ETF at a time to the next. And we just kind of roll through these markets. And it actually seems really slow and boring because we know what we're doing. We see these trade triggers happen days in advance. So we're prepared when they happen. There's no shock and awe. And that's the whole key. And of course, the whole strategy here, if you take a look, I mean, we dramatically outperform the SP 500. This is from the 2008 stock market top. We just consistently go up, which I call the strategy CGS, the consistent growth strategy versus the buy and hold. And this year, we're keeping pace with the SP 500, but we have very little drawdown. Our biggest loss is 6% versus 50 or 40% with the stock indexes or the buy and hold. And obviously the returns are dramatically bigger because we're only holding things going up, which means we compound faster and faster. And we're always compounding, which is really powerful. So yeah, people can visit and check out my site at thetechnicaltraders.com, which there's a special link down below that people can come to and see what I do.
Great. All right. We'll put the link down below in the description and in the pinned comments. So check out Chris by clicking on that link. Thank you, Chris. We'll speak again next time. Appreciate your
Thanks,
update.
David. Take care.
Thanks for watching. Don't forget to like and subscribe and protect your online privacy. Click on the link down below in the description. Join deleteme.com/David Lin or scan the QR code here for 20% off.